Hello and welcome to CIO Perspectives. I'm Sid All, the Co-CIO for Private Clients, Endowments and Foundations here at Brown Advisory, and I'm joined today by my Co-CIO, Erika Pagel. We're excited to have with us today Jordan Wruble, a partner and portfolio manager here at Brown Advisory and the head of our Investment Solutions Group, responsible for external manager selection across public markets. Prior to joining us, he had almost every job there is in the investment business over the past 30 years, from investment banking and private equity to hedge funds and proprietary trading. And he was most recently the head of research at a multi-manager hedge fund. He spent 10 years within hedge funds as an analyst, stock picker, and portfolio manager prior to the last 13 with us here at Brown Advisory. So we're excited to hear his views on the evolution of the investment business, how to select the best managers, and how he and our managers are viewing the environment today. Before we bring in Jordan, Erika, what's on your mind with respect to markets at the moment?
Thank you, Sid. Well, there continues to be a lot going on, and I'm looking forward to Jordan's perspective today. I'll start with a few things that are top of mind since we last spoke as we head into the final weeks of the year. There is this push and pull right now between equity market strength, despite high valuations, AI optimism and its market support, trade negotiations, and then some increasing economic vulnerabilities that are carrying some mixed economic signals. So first on the Fed, tough situation right now given limited data, just given the government shutdown. But September CPI did tick down, which is headed in the right direction for more rate cuts. And as expected, the Fed cut rates again in late October. Just remember that there was that long pause until September of this year when the Fed restarted its rate cutting policy. But what was more interesting was the commentary from Chair Jerome Powell that a December rate cut is not a sure thing. And in fact, the FOMC had some strong differences on this topic. Rate cut odds for December have now dropped to the 60s versus nearly 100% leading up to the meeting. But what's also on the radar of the Fed today is labor, weak payroll numbers, and what appears to be initial signs of a slowing job market. So once again, a lot of this data is not available right now. But what is pretty significant is over the past few weeks, there's been more and more companies announcing layoffs. And part of this has been a supply issue and restructuring related, but also part of this is layoffs that are more productivity improvements and AI specific. You've got Amazon cutting corporate roles, Meta cutting AI jobs, and then companies like Chevron, Exxon, UPS, Target, they're all reducing their workforce. And there's this new term, which is no hire, no fire, that seems to be popping up right now. And, if you look at the unemployment increase that we've seen over the past couple of months, a lot of it is at that entry-level position age group. Young workers' unemployment in August exceeded 10%, which is the highest that we've seen since COVID in 4 years. So all of this has spurred some renewed concerns of a recession. And then subsequently, we've seen some volatility in bond yields. Once again, the 10-year has now bumped back up to about 4%. And we're seeing some reversal in some of these interest rate sensitive sectors that have had some improved performance over the past couple of months. So I'd also mention that the odds of a recession is partially tied to this future AI spend, which brings me to a second point, which I know we're going to speak a lot about today, but expectations are high headed into this earnings season. You've got some areas where the Mag 7 earnings growth is nearly double or more that of the rest of the S&P 500. And we've recently heard from some mega cap companies. It's mixed. Earnings growth remains strong, but some of the results are not exceeding high expectations. And a few stocks have shown weakness on concerns over this AI spending spree. So I know we'll also talk today about market concentration. NVIDIA, now a mega cap at $5 trillion. NVIDIA represents something like a fifth of the volatility in the S&P 500 right now. And then we've also now started to see this year and more recently speculative buying, but some of that is cooled. Gold up more than 40%, largest increase since the 70s. Crypto's been volatile. But then there's been some more, what we think is more idiosyncratic risk right now with some of these defaults in credit. But we're really watching this, particularly downgrades and then the large amount of debt that's now funding AI growth. So there's a lot going on, Sid. It's really not an easy investment environment. Future market gains are likely dependent on the Fed, mega cap tech momentum, as well as earnings. And it's just really important right now when we're building client portfolios to balance that risk with potential return. Sid, I'll pass it back to you and ask the same question. What's on your mind?
Well, I think you hit one of the things, which is the Fed. And I think many are calling it a hawkish cut, the language that you referenced. maybe making it a little bit less certain that we're going to see those interest rate cuts come through later this year. Clearly, earnings season very much on my mind. And candidly, early signs are a pretty good earnings season. And we had higher than normal percentage of companies that are beating earnings expectations. And in some ways, on one side of things, I'm kind of in awe still of the performance of some of these mega cap tech companies. I mean, I was looking at the revenue growth year over year for all these hyperscalers, like in the mid-teens. We saw continued exceptional cloud growth from all the big hyperscalers, mid 30s for Microsoft. Amazon is re-accelerating their cloud growth. Obviously, a big focus is on the AI spend. Every one of them has basically come out and said that they're actually raising near-term expectations for spend, and you should expect even more spend next year. The market response to that has been a little mixed for sure. I think in the case of Meta, it was the biggest down day for the stock in a long time after they reported earnings because people are maybe getting a little concerned about how much is being spent on AI. But what we're still hearing from all these companies is the moment they bring on this capacity, it's being utilized, and the fundamentals of AI are still pretty strong. I'm thinking a little bit about a recent Wharton report that just came out on AI that had some really interesting data on whether or not companies are seeing a return on investment. There's a lot of studies that have come out that were referencing data from 6 or 12 months ago that were a little bit less conclusive. This one suggested 3/4 of companies are seeing a positive ROI and huge jumps in the percentage of their employees that are using AI daily across all different areas. So it's interesting. The fundamentals seem pretty strong with respect to AI usage. Certainly the spending is very strong, but all of this spending is really eating into the free cash flow of these companies as well. And so we need to make sure we see a return on it. And more of it's coming from debt funding. So I think it's about $120 billion this year of debt issuance from the hyperscalers in bonds, loans, including a big chunk from Oracle this year. That is like a 4 to 5x increase from last year. So a lot of debt going to produce this spending. But I'm sure we'll talk a little bit about that with Jordan as well when we get into things. Let's bring Jordan into the conversation. Jordan, long overdue. Great to have you on the pod.
Thanks. I'm excited to be here.
As I said in your intro, you've been an investor since the 90s. You had a front row seat to the tech bubble coming out of Stanford. You've seen a pretty big evolution in the investment business over the last 30 years. In your mind, how has the art and science of investing changed over that time, and how does it influence manager selection?
I love this question. In some ways, everything has changed. In other ways, nothing has changed. I think the beauty of fundamental investing at its core is that it's timeless. The market's going to put a price on companies every day, and investors' jobs to decide if those prices make sense. Most of the time, market's roughly right. Markets are pretty efficient. Once in a while, you get a fat pitch, a great business trading at a discount, or some other reason why you get an opportunity to drive better than market returns. That part hasn't changed. What has changed is how you find those opportunities. And investing is a mix of art and science, and most of all, it's competition. There's super high stakes. There's trillions of dollars moving around daily. It draws in some of the smartest and most competitive people on the planet. And so naturally, as edge comes up, it gets competed away and the market moves forward. You brought up 30 years ago, but before the internet, getting information was inefficient, was hard. So just having information was a source of edge. I mean, forget that research reports, statements, and whatever, it was all mailed out. Went through the post office, right? When I started as an analyst 22 years ago, my first hedge fund job on the buy side, building a good financial model gave you an advantage. Just getting into the numbers and making sure you'd done all the right pro formas of one-time events. Over the next 20 years so, I've kind of had moments where I've seen things that became more prominent drivers of edge. So the focus of cash flow over earnings, spotting quality compounders before that became a buzzword. That gave you an edge. And then over time, those insights become table stakes. So today, when we're selecting managers, we're looking for people who still honor that timeless principle, find things that are mispriced and build a portfolio of them. But the way they get there, that's where we're looking for them to have some unique insights into how they find those opportunities and the work they do. Super deep research into why the market might be giving you this opportunity. Why is the price not the fair reflection of its intrinsic value? And then you have to express those intelligently in a portfolio because that's where the theory meets reality. So for us, we just love getting in the weeds with managers, understanding how they're formulating their views. One advantage that we get is that we meet with the best investors around the world, and we actually get to see from them how edge evolves in real time. We tend to look for these 5 types of edge. Informational and analytical are the most common, that differentiated information, connecting the dots in a unique way. There's temporal, so that's time horizon, looking further out into the future. Behavioral, which manifests in different ways, but is often just about staying rational and objective, and activism. So rolling up your sleeves, bringing changes about to drive the value of the business. We're meeting with managers and hoping that that's underlying their approach, finding things that are mispriced. But yeah, the art and the science of it have evolved, and it'll be exciting to see what the future brings.
So there are a lot of academic studies that suggest it's basically impossible to outperform the market over time. And you and I talk about this a lot. Those studies are based on publicly available data. They don't include all the best managers, many of whom are in private fund structures. But you've done a good job finding managers that do outperform over time. You highlighted some of the things you're looking for in their ideas, but what are some of the most key characteristics of those managers? It could be more on the process side, but also the structure, key people. What's the special sauce?
First, I've got to say it's absolutely a team effort. We have an incredible group of people here. And one of the big advantages of a big experienced team is simply you can turn over a lot of rocks. And investing, you have to. There just aren't that many truly exceptional managers out there, and investing's hard. So our job is to look at all of them and try to keep a really high bar and stick to a disciplined process. Funny enough, these are sort of the traits, that curiosity, that rigor, that discipline that we look for in managers too. What makes great one? First thing you notice is passion. They love investing. Some of the best investors we work with could have retired years ago. They still show up every day. They're fired up, not for the paycheck, but I think just to compete. And they want to have their track record mean something. It's beyond the work. It's like their identity. And many of them will tell us they don't know what they would do if they weren't investing. Now, our process starts with what I'd call the knowns. It's a backward-looking part where we dig into the data, the track records, the team structure, and so forth. We analyze the returns and separate skill from luck. So we put sort of like want idiosyncratic returns, the kind that come from real insight and research, because those are repeatable, not the factor bets where you're leaning into growth or momentum. Now, the tricky part is you're investing for the future, not the past. So we have to see, is the environment that allowed these managers to be successful still the same? Is the team the same? Is the strategy the same? Is the asset base still manageable? That sounds easy. The reality is the world's always changing. It's incredibly dynamic. And so a lot of our edge just comes from the judgment from having done this for so long. Most of our managers are bottom-up investors. They focus on companies, not macro forecasts, and they're trying to figure out what a business is worth, what the market's missing, and why that mispricing should close over time. And that's where everything has to line up for us. Portfolio construction really matters. We love concentrated portfolios because it's hard to find a lot of great ideas, but you need your capital to be aligned with your business and structure. So if your liquidity terms or your investor base or whatever it is doesn't handle that kind of volatility, it's not going to work. And on the flip side, very diversified portfolios tend to limit any single name idiosyncratic risk. And that's where you have to be careful you're not taking factor exposure like we saw in 2022, where even kind of the safe growth quality names saw big multiple compression. So no approach is going to be bulletproof, and we're going to build differentiated portfolios of different approaches to doing this. But, it's about alignment, edge, consistency. And I think the best managers, that's what they're combining, is that passion, that discipline, that curiosity, and putting it in a structure that aligns with their business, their team, and their LPs.
Can I ask one more on that? We talk a little bit about the difference between a portfolio manager who's just a portfolio manager and a portfolio manager who really gets in the weeds, the kind of analyst, PM, player, coach, the Pete Rose analogy. What are your thoughts on that? How have they evolved over time?
Do we have to asterisk Pete Rose?
I think we do, yeah.
I think it's great when the PM is really an analyst at heart, because that infuses that fundamental drive to find a differentiated view, to really understand what's going on and why the opportunity exists throughout the organization. There's lots of different structures, and in some cases, analysts have a lot of responsibility in idea generation and driving things into portfolios. But I think our most successful single manager strategies are where the PM is in the model, is on the calls and is just really getting involved to the deepest levels. I think that's where, particularly for a concentrated portfolio, that really makes a big difference.
Maybe leading from this conversation, we could talk a little bit about the current environment. And it's been a really challenging year for many active managers, just given once again, we're dealing with market concentration, narrow market leadership from a few tech companies. And some of the indices today are not even considered diversified anymore. And you talk a lot about edge, but flows, algorithms, model-based investing, and momentum has also changed over the past 20 to 30 years, making fundamental investing even more challenging. So maybe we can take a step back and talk a little bit about what's working this year and what's not working.
Yeah, it's been an interesting year and a tricky one for a lot of active managers. Earlier in the year, we had a lot of macro noise, shifting policy, tariffs, inflation, and Fed policy uncertainty. It's tough for a fundamental investor because they're good at analyzing businesses and industries and not guessing what the government's going to do. When the headlines drive markets, it can make rational analysis feel a little futile. Right as we're experiencing all of that volatility, something else was going on, and that was AI adoption metrics exploded. You started to see usage data, token processing, ChatGPT subscribers, enterprise deployments just inflected substantially higher. That had coincided with the introduction of new reasoning models that weren't just more powerful, but more useful and required even more compute. And so this adoption took off, and many of our managers saw that inflection point and started positioning across the AI value chain, from the compute and the infrastructure and the hyperscalers to the energy powering it. And whether or not AI changes the world, and frankly, I do think we're already seeing it, the CapEx wave alone is creating massive demand for infrastructure. The chips and the hyperscalers were the obvious early investments. And interestingly, the bottleneck became the electric grid. And so utilities and independent power producers, gas turbine manufacturers, companies that used to be probably not in a lot of our portfolios, sort of the more boring corners of the market, are suddenly driving performance. But you're right. It's a very narrow market. A handful of mega cap tech names have carried a lot of the returns. And that's a challenge for diversification. It's a challenge based on how you structure your fund. It's also been a bifurcated economy. I had read that Harvard economist Jason Furman had said, I guess his analysis was AI investments drove 92% of GDP growth in the first half of this year. So in other words, basically the rest of the economy was flat. And Michael Sembelis from JP Morgan pointed out last month that AI-related stocks, which I think their basket is 41 names, generated 75% of S&P returns since ChatGPT was introduced in November 2022. But they're also generating 80% of the earnings growth. So that means like a big part of the economy has struggled. I think what's going to be fascinating is what happens next, because for this AI investment to make sense, the value has to eventually shift downstream from those building AI to those using it. And right now, the beneficiaries are the same names. Meta and Google are using AI for ad targeting. Anthropic and OpenAI are using it for code. But over time, we'll see the productivity gains have to show up in traditional business. And when that happens, the winners might broaden out from the enablers to the users. But yeah, it's been hard for managers, and I think we have to be patient with that.
You've got some interesting data on some of the factors that is driving market performance so far this year. Could you share some of those insights on investors' preference for stocks based on their profitability or momentum or even other factors? And then secondly, a little bit of a double question here, Jordan, what are the bulls and bears saying right now?
One of the more interesting dynamics this year is what hasn't worked. So valuation sensitivity, so that natural instinct to buy what looks cheap, has not paid off. It's been a tough year for investors who lean toward lower multiple stocks. Even within the value and smaller cap parts of the market, the cheaper looking stuff has lagged. We looked into the data across valuation quintiles, so just lining up the market by PE ratio at the start of the year. And it turns out the most expensive group, the top quintile, is the only one outperforming the benchmark. And that group can include a lot of unprofitable companies in certain industries. So the market's been focusing on growth and innovation and, yes, momentum. Stocks with strong price momentum, the ones that have been working, have kept working, especially when they're aligned with these narratives around AI, productivity, innovation. So it's been one of those years where mean reversion hasn't worked very well. And yeah, certainly it may feel like the market's been chasing some stories, some perceived winners, particularly in some smaller cap companies. The fundamentals haven't borne out, and for now, the stories can dominate in some of those.
Jordan, not everybody owns these seven stocks or owns them at weights. What are some of the bulls and bears saying right now?
I think the seven names that drove a lot of 2024 has broadened out a little bit to some of the downstream, the energy, and some of the other parts of the enablers, but it's still a very narrow part of the market. I think the AI bulls are looking at the growth potential around AI for business productivity, for either labor productivity, which is probably a synonym for headcount reductions, or at least not future hiring. And the bears say, hey, this is a lot of money being spent. And where is the productivity and when will we see it? And so I think the experience of like the 90s and the internet was you had a huge transformation of the economy. We talked about 1995 when I started my career was the year Netscape went public, and you had a lot of enthusiasm and a lot of infrastructure build. But there was also a huge amount of volatility around that as some of the promise of the internet took time. Will we have those same moments here? I think is an interesting question to discuss.
So on this topic and looking at some underperformance in this environment, how do you separate good managers that are just going through a challenging period of performance and stock selection versus those managers where we might need to take or make a change?
I think this is probably the hardest part of investing, whether you're picking stocks or allocating to managers, is how you deal with things going poorly. And I think when we look at managers, the best ones, the hit rates aren't that high. So you have to accept that there's always going to be some noise in returns, particularly in like the more concentrated, longer term oriented strategies. And so for us, it's really a lot about process over outcomes. I think it's interesting. I was thinking about, we don't tend to invest in systematic strategies in that they're black box. And when things go poorly, it's hard to know why. And it makes a decision about what to do with that strategy really hard. With fundamental investing, when prices fall, you can reassess, like, has risk reward improved? Have the fundamentals changed? And there's a tangible basis for that judgment. So this, I think, leads to an interesting thought about how we select managers. With an external manager, if you were just getting their return stream, it would feel really black box as well. And that's why we just have to spend so much time really being close to the managers, understanding what's happening in their portfolios, the decisions they're making, and whether those align with their process and the philosophy and the things that made them successful in the first place when we underwrote them. So ultimately, we're focusing on process, team, and the things that we can understand. And if that's intact, we want to be patient through periods of volatility, particularly, as we've said, times like now where a lot of people's strategies just don't line up with what the market's rewarding. And I think we need to understand that and know that that can happen. It's really if we see a change in the discipline, change in the team, decisions that don't add up for us, and that's where it might be time to make a change. But that's also why we have to just always work to find the next great managers. And there's a healthy competition of capital to keep us disciplined, to ensure our client portfolios are always in the best hands.
How do you think about the concentration of the market along those lines? Do managers get a bit more leeway from you given that the benchmarks they're being compared against are so concentrated today?
Yeah, it's an important question of whether the benchmarks are useful at the level of concentration. If you look at how much volatility exists in the top X number of names in the S&P 500, and you go, would I build a client's portfolio with 50, 60% of the volatility in 10 positions? Absolutely not. So I'm hoping there'll be some innovation around the benchmarks where this factor becomes more balanced, or we have to evolve a little bit around that pure comparison to the benchmarks. And with concentrated strategies, look, it's largely been pretty helpful in a number of our managers because they've had good performance from a small number of stocks. But you have to realize the more concentrated or the more tracking error, the more you're just going to need time to see whether or not that manifests. And so talking with some of our managers on very low tracking error strategies like alpha extension type strategies, the time horizon for which you will see evidence of skill is much shorter. So low tracking error, you're going to see that in a year. I think, given the metrics, call it a year, 14 months for really, really low tracking error, less than 1%. You should see that skill emerge. For high tracking error, it can be years. And so I think, again, we're trying to understand beyond just the returns, what's driving their investment process. What are they actually doing? Because you won't know in any given year in a concentrated portfolio, one with a lot of tracking error, whether or not the past returns are the best thing to hang on to, or if there's going to be better performance ahead. And so for us, again, I think that's the hardest thing to do. It's part qualitative. And it is also important to just have really high competition for capital. But ultimately, with a concentrated high tracking error strategy, we think you get awesome long-term performance, but you have to be patient with it.
Going back to AI for a minute, we've talked a lot about the investment opportunities, how some people are viewing the risks, but how are our managers using AI themselves in their research processes or risk management to get better? And what other questions are you asking them about AI?
Yeah, we started out talking about where edge is, and we didn't get into some of the more recent evolutions. It's not even that recent to talk about things like alt data and scraping data off the internet and the different tools that they're evolving, factor analysis and so forth. So obviously AI is going to be one of those areas where I think edge is going to be emerging, and it'll be probably initially as a productivity enhancer, right? I don't think it's going to be, or we're not likely to outsource investments to a model, but I do think that fundamental managers, like the ones we've been talking about, will be able to get up to speed faster on an investment, on an industry, and use it as a research assistant. And that will take what could have been hours of work and shrink it way down so that the parts that they add the most value on, which is judgment and experience, are driving the ultimate investments and decisions, and that they'll just be faster and more comprehensive. Behind the scenes, I think managers are investing in their data infrastructure. They want to integrate AI tools. We met a recent tech fund that was built an infrastructure that allows everything they do, for things that would be Excel-like data analysis to qualitative words, notes, and thoughts and so forth, to all be in one system that talks to AI, and which AI can do a lot of the work. Building that infrastructure well positions them to scale and to, again, turn over more rocks, be smarter and faster about how they do things. We're seeing it's not just like quants and data scientists using these tools. The non-technical analysts can use AI to code a script, to automate some analysis, or do something that really would have been impossible for them. So I don't think AI is replacing human judgment, but we're going to raise the baseline of what's possible. And hopefully investors have more time, more headspace, focus on higher level thinking and judgment. But I do think it also has the potential to shrink the alpha pool a little bit, as the least effective analysts maybe get caught up in some of the techniques that the best analysts have used.
My last question along the lines of AI, I have to ask the question, a lot of talk about a bubble in markets today. Do you think that the market is in a bubble today? And what are our managers saying about this current valuation environment? The last piece of this, are there any real-time indications of, are people shifting their portfolio away from some of these AI winners or the hyperscalers? Is there any nod to what's going on in the valuation environment today?
You mentioned I graduated from Stanford in 1995. That was the year Netscape went public, and maybe was the seminal moment for what would become the dot-com bubble. And I was in business school from 98 to 2000, and my classmates who didn't drop out to start dot-coms were sneaking off to trade internet stocks online. And so I have some familiarity with the bubble, and there are some similarities and some differences. I think in the 90s, the business model for the internet was still really being invented. There was plenty of excitement and almost no way to monetize traffic. Consumers didn't want to put their credit cards online. E-commerce conversion was close to zero. And it wasn't until things like Google AdWords came along that the internet actually had a way to function economically. Plus, we were still in the dial-up era, right? Slow connections, friction everywhere. Broadband meant not just faster, but always online. And then you had mobile. So AI has some of the same early stage excitement, but I think it's starting from a much more mature place. There's already billions in real revenues. Coding tools, Anthropic, those are already like a quarter of the DevOps market's revenues. And then you've got the ad-driven AI returns from Google and Meta and so forth. The corporate use cases, as we mentioned, are going to continue to get unlocked, and there'll probably be business models that we haven't yet imagined, in the way that eBay couldn't exist without the web and Uber couldn't exist without mobility. But the valuations today aren't anywhere near the extremes of the 90s. And build out is following real demand, cash paying demand for compute. The hyperscalers are all saying they can't build fast enough to get things online. But there are pockets of the market where it's clear, like there's a lot of narrative. If you look at small modular reactors, for example, like some of those story stocks are up 5x this year. that might feel a little detached. So we have some managers, as with all things, it depends. We have some managers who are trimming or have faded a little bit the next phase of return on CapEx or the tech valuations. And we've seen other parts of the markets like financials and some high quality industrials and aerospace be good opportunities for capital. And then I think some of our tech managers still think this is a very long and durable transformational technology. And we're not seeing any evidence of either a slowdown. We just continue to see more CapEx spend, which will drive a lot of this. And the valuations, maybe they're expensive, but they're maybe not at the extreme levels, I think some would say. It's funny. I saw this tweet from Michael Burry, who is famous for his call on housing before the GFC. It said, sometimes we see bubbles. Sometimes there's something to do about it. Sometimes the only winning move is not to play. And I think that's the short perspective. But I love that last line because, of course, it's referencing one of my favorite 80s movies, War Games, which is an all-time classic. So again, it's going to depend a little bit on the manager perspective. I do think some of the story stuff in the smaller end has probably hurt hedge funds on the short side this year. And it's also sent some of the benchmarks well ahead of where I think our traditional fundamental investors have gone into the spectrum. So as I said, it's definitely moving a lot of the market. And that's why we rely on our managers to do this bottom up.
Shifting gears a little bit, another area of strength this year have been stocks outside of the US in areas like Europe, Japan, and emerging markets. And many of those regions are all actually outperforming the S&P 500 this year. How are you seeing our global managers shift capital today, maybe on a company by company basis? And are they still finding attractive opportunities today?
Yeah, one of the real advantages of having like a truly global bottom-up manager is they can move capital where they think the best opportunities are, and it doesn't rely on making a top-down call about GDP or central bank policy, but where they see the best risk-adjusted returns. So really last year, we started seeing a selective rotation toward Europe. What's interesting is many of the companies they're buying aren't fundamentally different from great US businesses. They're high-quality global businesses. And they've just been trading at a more attractive valuation because they're in European markets. And that's created better IRRs, especially areas like aerospace and other industrial sectors that sell into global markets. So those have been rewarding and managers have done well with those. And in some cases, multiples have expanded. Some of the geopolitics of the past 12 months have leaned into this as well. But it's also been really useful as a currency diversification. So for dollar-based clients, that diversification as the dollar has weakened has also been a tailwind to returns. And yeah, we're still seeing opportunities overseas, not as a broad macro call, but one stock at a time. And skilled managers will find great companies around the world. And that can really be a tool for us to help drive diversification.
Maybe we can shift to Japan. Can you talk a little bit about the opportunity here and just how you went about finding managers to take advantage of this opportunity? And there's been a really strong run of performance. And is this still a good investment today?
Japan's one of the more interesting stories we've worked on in a while. And for years, we were comfortable being underweight Japan. It's a big economy, the fourth largest in the world, but it had serious headwinds, an aging demographic, limited growth, and a corporate culture that wasn't super focused on shareholder value. Plus, as we just talked about global managers, it's actually really hard for global managers to invest in because of language and culture. And I think it was earlier this year for the first time that the prime market of the Tokyo Stock Exchange required disclosures in English. So for us to be able to invest in Japan wasn't happening. For global managers, we were okay with that. A little less than 2 years ago, the Tokyo Stock Exchange announced a round of new corporate governance reforms. And Japan has had reform before. We had the 3 hours of Abenomics and so forth, but there were things that felt different to me this time. And that comes in part from going to Japan in the past and looking for investments and not finding either teams or that bottom-up opportunity that felt compelling. This time we met with Medi, we met with Tokyo Stock Exchange, we met with local companies, and we could feel the corporate sector was buying in. I think this is sort of a necessity for Japan, right? As an aging demographic, it's in a hemisphere dominated by China. They've got a fairly leveraged central bank. Like they need their economy to pick up and they need their citizens invested in equities. So they need to create this virtuous cycle of being in equities. So we kind of understood the motivation for it. And we sort of wanted to believe that this would have a chance. Now, Valuations in Japan were attractive, remain attractive. Companies are focusing increasingly on improving return on equity, which can drive higher earnings and importantly also higher multiples. And there's a growing willingness to return capital to shareholders, consolidate industries, hopefully through M&A. And seeing that in the data. So buybacks and dividends are up more than 30% this year. Shareholder proposals at annual meetings up, I think, 25%. Activist campaigns are at a record level. So those are real changes that we're seeing. And when we went to try to find an opportunity to invest, we wanted to go through a local manager. We wanted somebody who knew the market, who was focused on domestic companies positioned to benefit from reform, rising wages, and not just the big exporters that tend to dominate a lot of global portfolios. So I think this is a long-term structural story. And I don't think that the performance we've got is anything more than hopefully a reflection that it's starting to work. But I think it's going to be a long-term transformation. The market's still very underowned domestically and globally. Again, one of the points was to get households invested. I think household ownership of the stock market was something around 10% a couple of years ago. And in the US, that's like 40%. So this virtuous cycle of getting the households invested and making them wealthier helps a lot with that aging demographic issue. And I think the buy-in from businesses is really apparent. It's not happening immediately, but these are small changes that if they play out, you could see a substantial lift in multiples and a substantial improvement in ROEs from businesses.
Turning to biotech, which has been on again, off again, not so great, now great again. What's driving the resurgence in biotech performance?
Yeah, we've been invested in biotech for years, and it's mostly we like the beta and the alpha, and the beta story is straightforward. Society's willingness to spend on human health is just going to keep growing. And on the innovation side, mapping the genome, applying advanced computing power to drug discovery has made it faster, more targeted, improved hit rates, and it's opened up whole new categories like gene therapy and cell therapy. But the alpha is what makes biotech really compelling because it's a sector where deep expertise matters. Now, when money was cheap in 20 and 21, saw a lot of generalist capital flood in, saw valuations soar, a lot of mediocre companies went public. And then when rates rose, that hit the whole sector very hard. Biotech companies need often years of funding before profitability. And so higher discount rates can matter in an NPV sense, but also in an access to capital sense. So this year, a few things are happening. First and foremost, there's real progress in the science, and that's super important. There's a lot of new therapeutics being approved, and there's renewed M&A activity. So big pharma companies are going to face about $300 billion in a revenue cliff that goes off patent by the end of the decade, and they got to refill their pipelines. So that's been driving a lot of acquisitions. And the big pharma companies use the small biotechs as their R&D, and they get promising assets and buy them, and then they have the distribution, and that's the model. So this year, you've had certainly the reversal in rates has come down. I think that's both a fundamental tailwind and a sentiment tailwind, but it also feels very, very early. Really, there was a huge amount of underperformance for a few years. It still feels like we're not seeing any generalist capital going into the sector. And so valuations seem reasonable, and outcomes on balance have been really good.
Jordan, we've gone this entire conversation, and I don't believe you've said hedge funds once yet. And you and I have spent a lot of time looking at hedge funds over the last 20 plus years. They are one of the things that has been working this year. You now teach a course on hedge funds at Georgetown, in addition to your demanding day job. How do you talk about hedge funds to your students, and what are the key concepts you hope they leave the term knowing?
Yeah, the day one class is what is a hedge fund? And it's a tougher question to answer because there's a lot of differences. There's equities, there's event-driven macro, there's market neutral, there's sector focused. And so they're not homogenous. And spend a lot of time unpacking those differences and how each of the strategies work, how they generate alpha, and how they fit into the broader investment ecosystem. I think the most important takeaway I want students to leave with is why hedge funds add value to portfolios. And we had a great discussion last week on whether hedge funds are an asset class or a vehicle. And students read David Swenson's Pioneering Portfolio Management. And one of them, I think, summed it up well. It really depends. Depends on how the fund behaves relative to other asset classes. So, for example, a long-short equity fund that takes market exposure is still pretty correlated to equities. And in that sense, I think it can fit within the equity asset class, just with different volatility, hopefully a lot of alpha. Truly uncorrelated strategies. So that could be macro, it could be relative value, it could be the new multi-strategy long-short models. Those can behave like a separate asset class altogether. And that's where they can really improve portfolio risk and return. And so the takeaway is hedge funds are not monolithic and they're tools, but they can really be additive in the way they interact with the rest of a client's portfolio.
So how have you shifted your allocations within the universe, dialing up those true diversifiers and uncorrelated managers over time? How does a portfolio of hedge funds that you build today look different from one 10 years ago?
I think you hit on it. The long short strategies have found a little tougher path as that alpha has gotten competed down. We still have money with some truly phenomenal investors who are generating a ton of alpha, but there's probably fewer of those. And the other part, I think, is just getting to where these really uncorrelated strategies can play an important role for portfolios. And we're leaning into the multi-strats, I think, much more than we used to, really from my own personal history inside of one. I think the model has changed quite a lot. So I think when you think about the very sophisticated factor models that they're using to isolate idiosyncratic or stock specific return, the results can deliver to clients high return, low volatility, and very low correlation to broader markets, and do so in a repeatable way. That's incredibly valuable. And so I think getting to understand that model, how they're managing risk, how a lot of the gross exposure is really to neutralize the factors, momentum or valuation or whatever it is. That leaves a small slice of truly idiosyncratic risk. And that's what you want exposure to. But also because it's so well contained, you could scale that up with leverage without changing your risk profile too much. So I think our approach has evolved with the industry, and we still back exceptional long short managers, but we've leaned into these multi-strategies that offer something stable, diversifying, and probably more in other types of uncorrelated managers where you're moving up the efficiency frontier to return with less volatility, and more diversification is always better. And then because they're not daily liquid, but they're also not very long tied up vehicles, you have the opportunity to rebalance into different asset classes as they become more attractive. So you look at 2022, rates are down, equities are down. It's like the worst year for the quote unquote 60-40 portfolio maybe ever. Hedge funds did fine. And so not only do you have that improving your overall return, but you have the opportunity then to rebalance into things that have gotten a lot cheaper. And so if you bought equities then, you bought bonds then, maybe you shrunk hedge funds to do that, that actually drove even better returns than the asset classes overall, because now you're getting more access to those cheaper asset classes.
Another area that has grown a lot, both in the industry and our usage, is in these areas of portable alpha and alpha extension. Could you briefly describe for our listeners what these strategies are and how we use them?
Sure. Yeah. I think this goes back a little bit to Erika's question on the challenge this year for active managers. If portfolio performance has been concentrated in a handful of large companies or high valuation stocks, it's been hard to beat the benchmarks without taking a lot of concentration risk. And one of the ways we've addressed that for clients is through these portable alpha and alpha extension strategies. They're very similar in concept, just packaged a little differently. The basic idea is to start with beta to a market that you want exposure to. That's your core allocation. It could be through futures or replication of an index, and then to layer in alpha on top. So the alpha generation for portable alpha might look a lot like a market neutral hedge fund, and then buying futures on top of that. And so you're getting the market return plus whatever the alpha is for the hedge fund. And the tracking error you're going to get there is going to be what the tracking error of the hedge fund is, more or less. But you're going to have that full weight and exposure to that. The alpha extension model is a little more nuanced, and that's usually owning an index. Maybe it's replicating an index, and then it is levering on some additional gross market neutral, long short, factor neutral in the same way that we talked about for the hedge fund, but financing using the shorts of the extension strategy. And, it's going to be very low tracking error. And that's going to deliver market plus, hopefully, returns most of the time, where we view there's a lot of skill in the alpha generation. But just for a client that's got a diversified portfolio of different active managers, and maybe we find some great smaller cap managers that generate a lot of alpha, but that beta has been really tough. We're just reducing their overall portfolio exposure to that factor. We're just giving them a little bit more benchmark weight in their overall allocation, but we're not sacrificing better than market returns. So these are a really elegant solution for markets that are concentrated, and it makes traditional active management hard. And it's becoming a tool for us in building well-balanced portfolios. We have hedge fund oriented versions that are maybe very high turnover and not as tax efficient for taxable clients, but we actually have one that is incredibly useful for taxable clients and generates terrific after-tax alpha for our taxable clients. And so we're using this to help improve overall portfolio construction and deliver better after-tax returns for clients.
Jordan, where do we go from here? Where's the research team spending the most time under your direction at the moment?
We're spending a lot of time trying to understand AI from a how our managers are using it perspective to how it's changing the investment landscape and where opportunities are. I think one concern we have, right, we talked about how mean reversion hasn't been working this year. Well, with the internet, we saw disruption that never reverted. The internet disrupted industries, retail and traditional media and so forth, and there was no mean reversion in those. And so we've actually been talking to our value managers to see how much time they're spending on understanding what's changing so that they're not sort of blindly saying, this hasn't worked, but it'll come back, because there's some very cheap stocks in AI disrupted industries today. So 30 years ago, you had no internet-enabled businesses, of course. Today, 8 of the top 10 of the largest companies in the world are internet-enabled, from the chip manufacturers to the hyperscalers and so forth. And I think AI will have a big transformational effect, and there'll be winners and losers. And hopefully our hedge fund managers can make money on the short side from the knowledge-based businesses that are being disrupted, or some of the outsourced labor type industries that are being disrupted. We also are very concerned that what might look cheap won't in fact get better. And so we're having those conversations with our managers. I think it's also really interesting that what defines quality has changed a little bit because of AI. SaaS used to be considered super high quality. It was like the thing that worked incredibly well in COVID, when no matter what, you still needed to spend on software. And now there's a lot of uncertainty whether AI is disrupting it. And I think maybe in some cases, enabling software with AI will make it even more valuable. And in some cases, some of these solutions are going to get replaced. On the flip side, things that looked very commoditized are becoming decommoditized, in the sense that NVIDIA is designing connectors and memory and so forth into their ecosystem, and businesses that were more commoditized now have an edge for being designed into that ecosystem as sort of the best, and you're willing to pay up for them. That is leading to multiple expansion that makes sense. You want to pay more for quality. So things that look like quality are maybe becoming less predictable, and things that maybe used to be more commoditized, and maybe the electric grid and all of that industry as well, we talked about, are becoming higher quality. They're becoming more differentiated. Some have more monopolistic type power in the market. And I just think that's really interesting. So we're in the advantageous position of getting to talk to we think the world's best investors and learn from them. But then we're also want to see how things change and help our clients understand what's happening in the world.
I think that's a great place to end this, Jordan. This has been such a fantastic conversation. Really appreciate you taking the time, and we hope to have you on again soon.
Thanks.
And thanks everyone for listening. See you next time.